thank you to all of our partners at Cathay United for hosting this call on the U.S. macro investing environment, which you just heard from Joe, and on today's U.S. real estate investing market. It's really great to be with you. I always enjoy hearing Joe's view on the economy. I always hear something new. His thoughts and his outlook help us all in Blackstone's real estate business think about how to make decisions investing in today's U.S. real estate market. In terms of my agenda, my comments today on the U.S. real estate markets, I want to cover two topics and then open it up for questions. Topic number one, I want to talk about why we have a positive outlook today for U.S. real estate investing, especially in real estate assets that, as you heard from Joe, that can increase their cash flows even in a slower U.S. economy. And then topic number two, I want to talk about how and where Blackstone specifically is investing today in the U.S. real estate markets. And not surprisingly, as you hear my comments about how we're approaching U.S. real estate investing today, it'll be anchored in the same macroeconomic outlook that you just heard from Joe. An outlook of continuing near-term restrictive monetary policy here in the United States, higher short-term interest rates, low U.S. overall GDP growth, declining inflation, and stabilizing long-term U.S. interest rates. So let me get started by sharing with you a quick overview of Blackstone's real estate investment platform. As many of you know, Blackstone has been investing in real estate for over 30 years. We invest globally across the US, Asia, and Europe. And today, Blackstone manages over $300 billion of equity capital in our real estate business on behalf of global institutional investors, as well as global high net worth families. And all of these high net worth families invest with Blackstone through partnerships, like the partnership that we have with Cathay United Bank. In our real estate business, we have a team of over 900 investment professionals, and I am proud to be one of the partners running this global real estate investment business. A global investment business where today Blackstone is the most active buyer, the most active seller, and the most active financer of real estate in the world, where the scale of our real estate investing business gives us terrific advantages in terms of accessing proprietary investment opportunities, having proprietary data that gives us an advantage in underwriting deals, and in terms of accessing financing, attractive financing to finance our transactions. These advantages that come from the scale of our business have resulted in better investment returns for Blackstone's investors. Over the last 30 years, as an example, Blackstone Real Estate has generated a 16% net annual rate of return across all of our opportunistic real estate funds. And just as impressively, at Blackstone, we've had no losing equity funds since we started our business more than 30 years ago. We have profitably managed real estate investing in all of our funds through 30 years of business cycles, through the Asia debt crisis, the dot-com bubble, the global financial crisis, Brexit, and most recently, COVID. We're super proud of Blackstone's performance track record in real estate investing. One of the reasons for our outperformance has been our thematic investing approach. Our focus on concentrating our investing in real estate sectors where we see the strongest fundamentals, where we see supply-demand imbalances and long-term macro demand trends driving long-term demand growth, occupancy growth, and rent growth. Like housing undersupply in the US, driving long-term favorable fundamentals for rental housing. Like e-commerce growth driving favorable fundamentals for US warehouses. And like the acceleration in data creation and the need for data storage and cloud storage, driving fundamentals for data centers here in the US. Today in the US, we're actually seeing more dispersion than ever around the performance of different real estate sectors. Where you invest matters. Sector selection matters, and investors need to avoid sectors with struggling fundamentals. Sectors today, for example, like for sale housing, where the combination of rising construction costs and rising mortgage costs have made home ownership less affordable today than any time in the last 20 years for the average American family, and may mean flatter home prices for the next few years, not increasing prices. Sectors like commodity office buildings, where vacancy is at record highs, where landlords struggle to maintain occupancy today, and where we see downward pressure on rents and cash flows, and we may even see elevated levels of distress this coming year for commodity office assets. Sectors like enclosed shopping malls in the United States, which are on the losing end of the e-commerce trend, and where you saw a more than 20% drop in property values just last year. So we believe that sector selection and market selection are more important than ever when making real estate investment decisions in 2023. Let me take a few moments to explain why Blackstone has high conviction in investing in rental housing in 2023. Our investment here starts with the fundamental imbalance today in the United States housing demand versus US housing supply. During the last 15 years before the global financial crisis, we were building in America 1.6 million housing units per year. That is, if you look on the left-hand side of this chart, 55 new housing units per year for every 10,000 Americans. Since the global financial crisis, during the last 13 years, we've only been building an average of 1.3 million housing units here in America per year. That's only 30 new housing units for every 10,000 Americans. And this chronic underbuilding of housing, this 45% drop in new housing construction, is why we have a more than 4 million housing deficit in the United States today. And because of this undersupply, this underconstruction for more than the last decade, it's no surprise that today we have decade-high occupancies for rental housing like apartments, because when you can't find a house to live in, you have to rent an apartment. And this supply-demand imbalance is even more acute in markets where Blackstone has concentrated its investing. Geographic markets like the southern and western parts of the United States, the Sun Belt markets, where we have seen significant in-migration and population growth. And in these markets, we're seeing population grow more than 2.5 times faster than the rest of the United States. And we're seeing apartment rents grow 30% faster than the rest of the United States. So as you can see, combining sector selection, choosing the right real estate sectors like rental housing to invest in, and also choosing the right geographies, the right zip codes, the right markets to invest in, can drive alpha or outperformance in real estate investing today. And with US mortgage rates in the last year increasing significantly, buying a home today, as I mentioned, is the least affordable it has been in the last 20 years for American families. Home ownership, as you can see on the left-hand side of the chart, now costs 50% more than renting an apartment. And this is an all-time high home ownership cost. And it's leading Americans to buy less homes and instead rent apartments for longer periods of time. So in fact, high mortgage costs are actually increasing demand for rental housing. So while there may be softness in the to-buy housing market in the US today, We see continued strength across US rental housing markets, as you can see on the next slide. And in Blackstone's rental housing portfolio today, across our student housing portfolio, single family home for rent portfolio, and apartment portfolio, we're seeing this in high occupancies and increasing rents. 9% year-on-year rent increases in our student housing assets located at major US universities, and 5 to 9% real-time year-on-year rent increases across our other rental housing sectors. Rent increases that are above inflation and that continue to drive attractive single-digit EBITDA growth and attractive asset value increases. Remember Joe's comments about the goal of investing in 2023. Find assets where you can have growing cash flows. That is exactly what you have with rental housing today in 2023. And by the way, we believe the attractive fundamentals in rental housing can continue until the massive undersupply of the last decade is addressed. And we don't see that happening for the next 5 or 10 years. So this is a long-term investment theme. In addition to investing in rental housing today, we also see attractive real-time investment opportunities in the US industrial and US data center spaces. In industrial, our investment thesis is very simple. It's predicated on long-term e-commerce growth, driving the need for more warehouses, particularly last-mile warehouses. We've seen US e-commerce sales triple in the last 7 years to nearly $1 trillion. And we've seen e-commerce sales as a percentage of total retail sales double in the last 7 years, from 10% in 2015 to 22% today. And we at Blackstone see both e-commerce sales and e-commerce penetration continuing to increase. By the way, in Korea, China, and even in the UK, e-commerce penetration is closer to 30% today, and the US is at 22%. So at this long-term secular shift to e-commerce sales, together with more onshoring of manufacturing here in the US, is leading to increasing warehousing demand and propelling strong industrial rent growth that you can see on the right-hand side of this slide. And it's also leading to decade-low warehouse vacancy or decade-high levels of warehouse occupancy. In fact, today across America, warehouses are more than 97% occupied, less than 3% vacant. Just to give you an idea of how strong the fundamentals are for US warehouses today, last quarter, inside our Blackstone portfolio of warehouses, for every warehouse lease that expired in the fourth quarter of 2022, we replaced the expiring lease with the expiring rents with a new lease and new rents that were 48% higher. That's an enormous amount of cash flow growth. Again, remember back to Joe's comments about how important it is to focus on assets that can grow cash flows, especially in a slowing US economy. And I will tell you that at Blackstone, we expect to see these very attractive releasing spreads continue in 2023, 2024, and beyond, continuing to drive very attractive cash flow growth at US warehouses. And at the same time, we at Blackstone made our first large data center investment in 2021 after more than a decade of studying the sector. We made the investment because we saw the demand for data centers about to take off, about to reach all-time highs, led by data storage demand from cloud companies like Amazon, Microsoft, and Google. By the way, a little known fact is that we have created more data in the world in the last 2 years than we have in all of human history. So you can imagine that with this unprecedented amount of data creation, the needs for data storage at data centers is also increasing incredibly quickly, which has driven vacancy at US data centers down from 10% just 3 years ago to less than 3% today, and has driven rents to grow, as you see on the right-hand side of this chart, 15% year on year. Again, at Blackstone, our focus is to find and then invest in sectors and markets where we see some supply-demand imbalances, where we see demand growing faster than supply, and where we can see occupancy growth and rent growth and cash flow growth. And across our largest investments today in rental housing that we just talked about and in industrial that we just talked about, research analysts are projecting that we will see 8% EBITDA growth or cash flow growth in 2023, this year. And that's in a market where we're likely to have 0% US GDP growth and 0% earnings growth across the S&P 500. And so this again harkens back to what Joe was talking about. Focus on investing in assets with growing cash flows. And as we look beyond 2023, I want to share with you just a couple quick facts relating to supply-demand imbalances in some of our major investment themes that should lead to continuing strong performance, at least how Blackstone analyzes it. First of all, with banks here in the US pulling back substantially from financing new real estate construction projects, we're seeing real-time material reductions in new construction starts, new real estate construction starts here in the US. Joe said his data showed a 35% reduction in US new housing starts. This slide shows a 25% reduction just in the last 6 months in US new housing construction starts. And in fact, in the last quarter, literally the last 90 days, we've seen a 40% drop in new industrial construction starts as banks are pulling back from construction financing. And this declining supply is a huge tailwind for real estate occupancies and real estate rent levels. Reducing new supply of warehouses by 40% is actually no different than increasing the demand for warehouses by 40% in terms of the positive effect on warehouse occupancy levels, rent growth, and cash flow growth. At the same time, as we think about Joe's earlier macro comments, I want to share our thoughts on how interest rates relate to the US real estate market. Rapidly increasing interest rates last year drove the performance of most asset classes. As interest rates rose last year, we saw discount rates rise, PE multiples for stocks decrease, and we also saw multiples decrease across almost all other asset classes. Real estate was not immune. Rising rates led to lower real estate multiples. It led to what we call rising real estate cap rates. As we start 2023, fortunately, and as Joe outlined, although we may see 1 or 2 more bumps in the Fed funds rates, in the short-term interest rates here in the United States, there is on the long end of the financing curve, on the 10-year US Treasury side, substantially less risk of the type of interest rate increases that we saw last year. Instead, as we see inflation moderating, we see much more stable long-term interest rates, and stable interest rates lead to stable multiples, not declining multiples, and lead to stable real estate cap rates, not increasing cap rates, which would be a very favorable outcome for real estate investing in 2023. Said another way, with stable cap rates, with multiples stable, real estate cash flow growth will not have to fight declining multiples as it did last year. Instead, real estate cash flows can drive asset value appreciation. So, as we enter 2023, you will see Blackstone be active in US real estate investing. in sectors that we talked about, like data centers, where we see demand and a shortage of new supply and healthy long-term fundamentals. And even possibly taking private some publicly traded REITs and sectors with favorable fundamentals like rental housing, REITs that are trading at big discounts to private market valuations due to the market dislocation. With that, I'm going to turn it back to Erin for questions that you might have.
Yeah, thank you, AJ, for sharing your thoughts on the U.S. real estate. I think it's exciting for all of us to hear about the strong fundamental driving the high rental growth in the rental housing, warehouses, data center that you just mentioned. Now, the first question, though, is I think given all that you mentioned, all the opportunity across the board, but just in a more summary way, can you let us know, just in case of a potential, say, economic slowdown, what are the opportunity and risk you see in the U.S. real estate market that the client should pay attention to, and how would Blackstone manage these risks?
Sure. Let me start by saying, as Joe also mentioned, the Blackstone base case is for a very slow U.S. economy this year, plus or minus 0% GDP growth. And as a result, within this overall slowing economy, we have to focus on assets that have growing cash flows. And that's why I outlined our case for warehouse assets, data center assets, and rental housing assets. But make no mistake, some opportunities will arise from this overall low growth US outlook. For example, as we talked about, with a slowing economy, we're already seeing US banks pull back on new real estate construction financing, and that will mean less new competitive real estate being built. And that's very positive, medium term, for already built real estate assets. It's very positive for occupancy and rent increases. At the same time, in the short term, as these banks pull back from financing, you're going to see some real estate borrowers having difficulty financing or refinancing their existing assets. And that's going to cause some buy-side opportunities for firms like Blackstone that have liquidity, especially when those borrowers who can't borrow actually from the banks have to sell their assets in a dislocated market. Also, I would point out, in a slowing economy, again, investors will have to focus even more on finding cash flow growth to drive value and asset appreciation. It'll be hard in the overall S&P to do that with flattish earnings growth. And as Joe mentioned, turning to alternatives like private real estate, where you can have growing cash flows because of market selection, because of sector selection, will be actually really important. I think that is our base case, a very slow US economy. But again, echoing Joe's comments, within that slowing economy, we need to find the patches, the sectors, the areas where we can actually have attractive cash flow growth.
That's exciting, AJ, for sure that there are a lot upcoming exciting deals for us to do. And that follows the second question. I think with regards to the recent development on one of the Blackstone's core plus real estate strategies, repurchasing activities. So what's Blackstone's strategy in managing liquidity and hopefully have capital that could capture the new opportunities in the market this year?
Sure. Well, as you know, Blackstone's goal in our income-focused real estate strategy is to deliver Blackstone-level outstanding investment performance, combined with what we call semi-liquidity, with a monthly or quarterly liquidity mechanism to permit shareholders to sell their shares when they want to sell their shares. And remember, we're investing in real estate assets, not liquid securities like stocks. And we're investing for the long term and to generate long-term attractive returns for our investors. And although our number one focus at Blackstone is delivering excellent returns, We pride ourselves that we can deliver these excellent returns together with a structure that offers regular liquidity for our high net worth investors. And to maintain this liquidity mechanism, this repurchase mechanism, we've always maintained and today maintain a fortress balance sheet with enormous liquidity, with like over $10 billion of immediately available cash, in addition to billions more of liquid real estate securities. And we also take in new capital every month in these funds from new shareholders who want to gain exposure to our portfolio. And this fortress balance sheet, together with regular way ongoing new investments, allow us, when investors desire to have liquidity, to repurchase up to 5% of our fund's capital base every quarter and actually deliver both liquidity and returns to our investors. What I would close by saying is that this structure that we have is a real innovation. As many of you know, historically, for the last 30 years, or even today, institutional investors in alternatives like private real estate, like in Blackstone's high-performing closed-end real estate funds, they basically have very limited liquidity. They've locked up their capital with Blackstone for 10 to 12 years, and in return, they receive that, what I mentioned in my first slide in the presentation, that 16% net annual rate of return. What we've done for high net worth investors like Cathay United clients is really special. We've matched Blackstone's performance with some regular monthly and quarterly liquidity mechanism, and can deliver what is normally an illiquid exposure to private real estate with liquidity up to a 5% mechanism that we support with enormous amounts of liquidity on our balance sheet.